Hi, good afternoon. Welcome to the November 2020 Wealth Factor review and update. My name is Bill Woodruff. I'm the founder and am responsible for the investment activity at WealthFactor. Before I get too far in, a few words for compliance purposes. This call is for informational purposes only and may be recorded. Statements made during this call are the opinions of the speaker and are subject to risk and uncertainty, some of which are significant in nature and by their very scope beyond the control of WealthFactor. There can be no assurance that such statements will prove to be accurate, and actual results and future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. In terms of a quick introduction, WealthFactor was founded in 2017. I have been actively involved in investing for over 20 years now and have a diverse background across the investment industry, both involved in local boutique investment organizations, as well as the publicly traded asset manager Fortress Investment Group. WealthFactor is a Lake Oswego-based digital wealth manager. We offer personalized, plan-based investment advice and solutions. We provide managed custom portfolios comprised primarily of individual securities, including stocks and/or bonds. Accounts are held in each client's name at an independent third-party custodian, and we charge a 0.35% asset-based fee for our services. In terms of a quick update, since our last monthly call, our team has grown, and I'd like to welcome and announce the addition of Russ McAlmond. Russ has been involved in financial planning and investing for over 30 years and has a diverse background and a significant number of credentials. And most notably, he's a certified financial planner, and he'll be heading up and responsible for ensuring that each one of our WealthFactor planning clients receives the highest quality financial plan service possible. The second person I'd like to introduce and announce the joining to the WealthFactor team is Tyson Edwards. Tyson's been brought in to enhance and accelerate our aggressive technology initiatives as we seek to enhance and simplify the user experience, integrate all elements of our business, and continue to enhance our automations. So jumping into financial markets. So today we're going to go through and kind of focus on November. Per our standard process, though, we don't spend a whole ton of time getting really focused on details on an intra-month basis. It's our belief that a lot of the movements on an intraday, daily, monthly, even quarterly basis tend to be more noise than useful information. And consistent with that philosophy, we won't be spending and emphasizing a lot of this sort of activity that we see. Instead, looking at and trying to provide a proper context to think about our investing in general and help maintain a preparedness to avoid some of the potential pitfalls and challenges that many investors end up succumbing to because of the practical challenges associated with publicly traded financial markets. So today we can look back over 2020 and see that we had multiple reminders that we shouldn't try to time markets, and markets in their V-shaped recovery and the acceleration of very strong performance for 2020 as a whole is a great example of why one should not look at a macro environment or take a view on the direction of markets and think that that's going to be a useful view and information that they should act on. So we're gonna spend a little time looking at and answering the question, why have markets moved higher? In simplifying, we have an election that's behind us, and investors and markets like certainty, and so we're on a path forward, and a certain path forward is better than unknown. Secondly, we're seeing a fairly good expectation for a return soon for an upward trajectory for corporate profits, and as we look at what markets are, it's really a representation of the future. Prices are really a representation of the future expectation for corporate profits into the future. And then, evaluations, thanks to the recent run up in price, have kind of re-entered historically high levels. And as I've said, and these calls in the past, valuations don't tend to be all that useful from a predictive perspective, but I think it's always important to be mindful about where valuations are relative to historical norms and averages. So with this graph here, we're looking at the annual returns going back about 40 years and with the bar chart, and then the red dot is the lowest point in each year. And I think this is an excellent graph to look at in this calendar year, where we had our significant coronavirus-linked decline in the spring, and now we find ourselves for the end of November up 12% year to date. So reinforcing the point that I just made in regards to it's really dangerous and probably not useful to try to time and predict markets. If there were ever a year where if you were to try to feel your way through investment decision making, you would feel like you didn't want to have be invested this year. And practically speaking, exiting at any point was very clearly, given how much we've seen increases in equity prices, generally speaking, that would be a decision that would be suboptimal. I don't often spend a ton of time thinking about or talking about corporate profits, but it's worth thinking about and looking at them conceptually. It's a lot of people say, well, I don't understand why markets go up and what's driving markets higher. And in the short run, the answer to that is very much sentiment driven. What does the market think? In the long run, though, there is absolutely a relationship between the growth of aggregate corporate profits and the direction of the markets. And so we can see this graph going back to the late 80s, and we see a steady, generally steady, obviously there are periods of retraction, but generally fairly steady increases in corporate profits. And with the blue lines are consensus analyst estimates, which, if you're going to predict anything, including corporate profits, you should likely do so often, as they're just as difficult to predict as anything else in publicly traded financial markets or economies. However, it is probably a reasonable reflection of the market sentiment relative to future corporate profits. And so we can see the expected decline that's coronavirus linked, but we can see that very quickly there's an expectation that profits will be higher than they were prior to the coronavirus. And so this graph helps lay a contextual foundation for why we're seeing markets go up, and it's largely the expectation that the coronavirus won't have a meaningful long-term effect on corporate profits. Another thing that I think is worth taking a look at is thinking about the market relative to sectors. So we're seeing a year where the S&P through the end of November is up approximately 12%, but that's not, and as it almost always is, normally distributed across sectors. And so we see a variety of sectors that are far more reliant on large groups or in-person interaction, struggling this year, and that makes sense relative to the way in which we've been forced to do business post pandemic and coronavirus. And we're seeing online retail and tech leading the way from a sector perspective, again, consistent with the current environment. So I consistently, whether it's on an individual security basis or sector basis, as well as aggregate overall market, do not believe one should look at this and try to identify patterns or modify the way in which their portfolio is positioned, and believe that one should instead think about the dynamic of the composition of a portfolio more from a risk efficiency perspective, and build a diverse portfolio from a sector standpoint. That concludes the prepared comments for today. As always, we welcome the opportunity to answer questions or be of potential assistance.